My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special West Coast edition of Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you make some money. My job's not just entertaining, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Let them eat bonds. That's pretty much how Wall Street reacted to the debt ceiling talks today. It seems buyers who were everywhere except in the defensive stocks that historically thrive in recessions have simply decided that bonds don't matter. It's like they don't care about the debt ceiling negotiations at all, and they're not the least bit daunted or even worried about a possible government default. We finally pulled back into the close when bond prices fell and rates moved noticeably higher. Dow ultimately closing off 140 points. The S&P inching up 0.02%, and the Nasdaq advancing 0.5%, where all of those growth stocks are. The market's overall resilience astounded most of the people I talked to. So is today's action right? Is it possible the whole debt ceiling standoff is meaningless? That's certainly what the market seems to be saying. Look at what went up. The stocks of companies that don't have much money, the ones that reported terrible quarters, the Cathie Wood kind of stories about no profits, just future growth in so-called out years. The buyers of the stocks of these companies seem indifferent to what's happening now, including those nasty debt ceiling talks. Here I'm talking Atlassian or Twilio, HubSpot, anything cybersecurity. These are companies that help other businesses do their job better. I can't believe their clients won't be hurt by a government default, but the market sure seems to think that they'll be fine. No, they'll be better than fine. Then there's a second group of stocks that rallied hard today, the companies that have been hurt by the threat of artificial intelligence. We're seeing so many tech plays that have been threatened. Witness a stock like that of Five9, which is a cloud-based call center software story. That can be replaced. That's right in the crosshairs of generative AI. Now the stock's soaring. It's the revenge of human intelligence, at least today. Long-term, I'm betting on machines, though. Meanwhile, what got hurt? Well, this is really interesting. It's the classic growth stocks that got hurt, the ones that used to rally on fears of a government default. Think PepsiCo, General Mills, McDonald's, Procter & Gamble. These have had gigantic runs for months on fears of a Fed-mandated recession. But now they're being annihilated, as though the market's going to take the debt ceiling debacle in stride, and it won't slow down the economy even if talks break down. Now, you don't see the stock of PepsiCo down $5 unless Wall Street thinks the economy is about to roar. Same with one stalwart Hershey, which the sellers finally got to. Of course, there is another way to look at this. Today, a brokerage firm suggested that year-over-year comparisons for all these consumer packaged goods companies could be not so hot. Now, I disagree with this. Their costs are finally coming down hard, but they haven't had to cut prices at all. They're in the sweet spot, even if we crash through the debt ceiling deadline. They'll bottom maybe in a day or two. Ultimately, we need to ask ourselves what works if everything goes wrong with these negotiations. Will it simply be another reason to buy growth stocks with little in the way of earnings? All right, let's think about this. What industries would really be impacted by the government defaulting on its debt payments? First, anything real estate should get killed because long-term interest rates should soar, make it insanely expensive to get a mortgage. The home builders did take it on the chin today. That made sense. Second, the pain should extend to the banks. Banks will take their cue from treasuries. They won't even know what to do if the government can't cover these coupon payments, so the banks all go down. Again, we had a mixed picture, though, because the troubled PacWest raised a bunch of money to save itself. But that's about the mini bank crisis, not the debt ceiling debacle. A lot of crises going on. Third, the utilities that need to borrow money. Now, one look at the stock of Dominion, 52-week low, will tell you what could be occurring. You know, I'm beginning to worry if that 5% yield is safe. Finally, any company that needs credit to sell goods like heavy machinery, aircraft parts, autos, they should be, they could be momentarily hurt. Maybe that's why Ford stock did nothing, even after CEO Jim Farley committed to a sharply higher cash flow number than Wall Street was looking for. I think the market's underestimating Ford's free cash flow generation. You see a stock of Tesla, though? That's not quitting. Oh, I just gave you a pretty eclectic group of stocks that the market's saying avoid. But if the government really defaults on its obligations, then any company that needs credit instantly could be a possible pain point. I get that. But if you don't need the bond market, if you don't need credit, today the market said look out above. Why? Right, let's think about why the growth companies with no earnings could do so well today, with even many of the mega cap techs also doing well, although they pulled back into the close. There are a few potential explanations here. First, While the real economy could get hurt by a debt ceiling implosion, the new economy probably doesn't get hurt. These tech companies don't care if the government isn't functioning or people don't get their Social Security checks. They have zero exposure to that. They aren't retailers who could be hurt by lack of consumer spending power. They aren't hospitals that might not get paid if Medicare runs out of money. All those are possibilities. Instead, these are companies that in many cases already screwed up, at least when it came to reports. I saw a lot of short covering here today. Upstart's moving higher despite real credit issues. There's a short covering in PayPal going on for certain. Maybe if you screwed up and came back, a sovereign debt fiasco can't hurt you. Quizzical. By contrast, the big cap tech companies that are doing well actually sold off when interest rates started rising today. It's the most speculative stuff that worked. There's another view, though, and this is a very cynical one that I'm going to put out there. This one has little to do with the nitty-gritty of the government. This view says, who the heck cares? It's all theater. The Standard & Poor's downgraded our nation's debt once before in 2011, and it turned out to be a colossal buying opportunity. JP Morgan put out this fabulous piece today, just last week, about all the negatives that could occur if our government runs out of money. Get a technical default that's seen as lowering Treasury yields, but actually steepens the yield curve. This is pure conjecture, mind you. The Treasury auctions could be postponed. Maybe Treasuries can't be rolled over. Maybe the Treasuries that miss payments could be repaid. Maybe they can't be. There'll be some sort of compensation. Money funds will have to do what they can without redemptions, but it won't be drastic. I mean, that's all the stuff just swimming. There's so many permutations of securities that interact with U.S. Treasuries that all the pricing mechanisms and all the institutions that need these coupons are going to find themselves in a real jam. But it should be a jam that can be sorted out. Maybe that's what the market's saying. No, you're not going to see a real country run out of money. But America is known throughout the world now as a dysfunctional nation purely because of our venomous political environment. We don't want the dollar to lose its reserve currency status. But a 5-day, even a 10-day hiatus, well, the market's saying it probably won't impact things. Just everything else except for stocks. If you go through the JP Morgan analysis page by page, you do find yourself thinking, what does any of this have to do with the price-to-earnings ratio of Bristol-Myers? My time-honored phrase that says, avoid looking at anything but the earnings of companies. The bottom line, the simple truth is that in the absence of actual numbers being cut, maybe nobody cares, at least for the moment. The giddiness, though, seems totally out of place with what could await the overall market, both stock and bond, if we don't solve these problems before the government really does run out of money. Let's take some calls. Let's go to Ken in Nevada. Ken.
Hi, Jim. I'm a long-time listener and first-time caller, and I have a question about Cummins. Bought it a few weeks ago. Looked like the last two quarters have been doing very well, but the stock's been dropping.
Well, it almost yields 3%. Ken, I got to tell you, it's a great American industrial. The problem is the industrials are selling off right now because rates are going higher. I have faith that Cummins is going to make a comeback, but it may be a little bit wild because I think a lot of people feel the economy is going to slow down because of the debt crisis. It's hurting the industrials more than any other group of stocks. Let's go to Scott in South Carolina. Scott.
Booyah, Jim. How you doing?
I'm doing well. How about you?
Good, thank you. Hey, last week you mentioned 5 defense stocks, and all of them have had a pretty decent run in the last couple of years, but there's one I've been looking out for, and it's been on a steady decline for the last year. I'd like to get your take on why that is and if I should be buying in now or waiting for something else. The name is L3 Harris.
This is an amazing decline in the stock because it's exactly the kind of high tech, so to speak, that the government wants all the military to adopt. But this is a company that is viewed as being right in the crosshairs of a possible sequester of the defense stocks. And that's why I think it's having trouble finding its footing. At 15 times earnings, I think you'll do fine, though. It is too cheap. Let's go to Ann in Indiana. Ann.
Hi, Jim. As a club member, thank you. Thank you for everything, and thanks for taking the call.
Thank you.
So I'm just, having some self-doubt here, wondering if I should be in Coterra with exposure to natural gas and oil, a CEO who's staying, yada, yada, instead of Pioneer or Core Holding.
No, I don't want you to say Coterra's terrific, Ann. I mean, look at how the stock acted today with natural gas down. It's got a great mixture. Their natural gas cost is $1, so they're still crushing it, even right here. I think Coterra's terrific. At one point today, the stock was at 26 and change. Please stay long that stock, and thank you for being a member of the club. Let's go to Bob in Florida. Bob.
Hey, Mr. Cramer, thanks for taking some time to talk with me. How you doing?
I'm doing well. How about you, Bob?
I'm fantastic. I'm a club member. We missed you this morning, but glad to talk to you right now. But hey, I had a quick question on Marriott with the travel industry being so bullish and margins increasing. Think it's a buy here?
This stock down $4. I like very much. Thank you for being a member of the club. I'll tell you what, Marriott is the last bastion of the companies that are doing well because travel is doing well. I also like the cruise ships, but this one is a good one. I would stay long Marriott. All right. The simple truth is that in the absence of actual numbers being cut, maybe this market is saying that nobody cares about the debt ceiling after all, at least for today. On Mad Tonight, you know my stance on Apple, own it, don't trade it, but what should you do with an Apple supplier like Skyworks Solutions? I'm checking in with the CEO. Then I'm always on the hunt for the next big bull market, so what sector could be setting itself up for a major run? I'll reveal it, and you'll like it. And SEP reported a quarter that shot the lights out. So amid a host of questionable market headwinds, could a utility like this be a way to get defensive and get growth? I'm talking to the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.